Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today, we are undertaking a detailed examination of Transocean Ltd, that's ticker RRG.
And this is a really crucial company in the offshore drilling space. I mean, they're one of the leading international providers.
They really are, and they specialize almost entirely in that premium tier, high-spec, ultra-deep water, or UDW, and harsh environment, HE floaters.
So our mission today is pretty critical. We need to dissect their Q3 2025 results, which, cover the period ending September 30th. And we need to pair those financials with the, frankly, incredibly aggressive strategic actions they took right before and after the quarter.
Right, their capital structure maneuvers, their operational wins, and the whole forward market outlook. It's a lot to unpack.
And right away, this presents a major tension. The picture at Transocean is, well, it's fundamentally contradictory.
It really is. On one side, you have management delivering superior operational metrics. We're talking high utilization, high efficiency, and really visible progress on debt reduction.
Which all speaks to a strong, improving business.
Exactly.
But then on the other side, the quarter's GAAP performance was, absolutely devastated by massive non-cash losses.
Almost $2 billion in asset impairments. It's a staggering number.
So that's the classic high-spec equipment, high-debt problem playing out in real time.
It is. So our goal here is to investigate if that strong operational narrative, the one driven by premium assets and execution, is robust enough to overcome these huge balance sheet headwinds that are still very much in play.
Okay, so let's begin where Transocean wants us to start. The top-line performance, which, shows some clear strength.
Absolutely. When you look at Q3 2025 versus the same quarter in 2024, the contract drilling revenues landed at $1,028 million.
So that's a measurable increase. What's that, about $80 million year over year?
Exactly. An $80 million jump, which translates to about 8% growth from the $948 million they recorded in Q3 2024.
And importantly, this result was actually a bit above their own guidance.
It was, which is always a good sign. It signals better execution than they even projected.
So the real substance, I think, is in dissecting how they got that $80 million jump.
Yes. This gives us the operational clarity that management is so keen to showcase. The growth wasn't just, from one lucky high-priced contract. It was systemic.
Okay.
So approximately $30 million of that came from improved revenue efficiency across the fleet.
Right, which means less downtime.
Precisely. Another $25 million came from higher average daily revenues, so better pricing. And then $15 million was attributed to just increased utilization, meaning more working days for the fleet.
That $30 million from improved revenue efficiency is arguably the most valuable piece of that.
I agree. It's structural.
It means less downtime, better maintenance, higher reliability, all critical things when your customers are paying $500,000 a day for one of your rigs.
That's the key. And if we break down the Q3 revenue by asset class, UDW floaters brought in $696 million, with the HE floaters responsible for the other $332 million.
And we should probably zoom out a bit, too. The 9-month comparison for 2025 versus 24 tells an even more powerful story about the market recovery.
It really does. 9-month revenue for 2025 hit $2,922 million. That shows a substantial 14% increase from the $2,572 million they recorded in the first 9 months of 2024.
And the breakdown of that 9-month jump is pretty encouraging. Almost 2/3 of that 14% growth was driven by volume and efficiency.
Right. You saw about $105 million from higher average daily revenues, $85 million from more utilization, and $65 million from increased revenue efficiency.
And on top of that, they got another $65 million from the increased activity of their newest UDW floater, the Deepwater Atlas,
which is a high-margin premium asset.
So this really confirms that the operational improvements are, sticky and growing.
Okay, so strong revenue growth. Check. Now let's get into the cost structure, which did see an increase, but one that management was pretty quick to justify.
Yeah, their operating and maintenance, or O&M expense, rose to $584 million. That's up from $563 in Q3 of 24.
And management attributed this $21 million increase to a few key things. $10 million was from increased activity across the active fleet.
Which is a good cost, right? It correlates directly with revenue.
Exactly. Then they also saw $10 million in increased reimbursable costs, which are often passed directly back to the customer.
And the last $10 million.
That was inflation, effects on personnel and operating supplies.
What's interesting, though, is how they managed to neutralize some of that inflationary drag.
Yeah, they had a favorable offset. a non-cash income of $10 million that came from a provision release due to a favorable legal outcome.
So even as inflation was hitting them, they were able to contain the net increase in O&M.
Through efficiency and that one-time gain, yep. And their G&A, general administrative expenses, remained very stable at $46 million.
There's a crucial detail here that I think often gets overlooked in this whole fleet rationalization process.
And what's that?
Depreciation and amortization expense. It actually decreased by $29 million, settling at $161 million.
And that's a direct consequence of their decision to sell or classify older rigs as held for sale. The depreciation clock literally stops when you make that decision.
So all of this operational data, it really points to a company that's hitting its stride.
It does. But now we have to turn to the item that renders the GAAP bottom line nearly unrecognizable.
The impairment charge.
The impairment charge.
This is the elephant in the room. The loss and impairment of assets in Q3 2025 was, it's a truly staggering number, $1,913 million.
That's $1.98 per diluted share, net of tax. Just for context, the prior year's impairment was only $629 million.
And the year-to-date impairment loss for 2025 totaled over $3 billion.
So you have to ask why. Why take this massive non-cash hit now? The market is clearly recovering, day rates are rising, so why aggressively write down these assets?
The strategic answer has to be that they're just clearing the balance sheet.
That's it. They're positioning themselves for long-term health. They've decided that these older, less competitive units, the Deepwater Champion, the Discover Americas, Clear Leader, India, and the Henry Goodrich floater, they just have no place in their premium-only future.
So by classifying them as held for sale, they crystallize the loss now. It reduces future maintenance expense and just lets them move forward with a cleaner balance sheet.
But that action completely destroyed the GAAP bottom line.
Oh, completely. The operating loss for Q3 2025 was a staggering negative $1,677 million, driven entirely by those impairments.
And the net loss attributable to controlling interest settled at negative $1,923 million, or a diluted loss per share of negative $2.
But, and this is the critical distinction for investors, the company and analysts, they largely ignore this GAAP number for operational purposes.
Exactly, because it's a non-cash, one-time cleaning event. The company instead highlighted an adjusted EPS of positive 6 cents.
Which actually beat consensus estimates of 3 cents.
It did.
So that leads to the necessary reconciliation. How on earth do you go from a $2 GAAP loss to a 6-cent adjusted profit that beats estimates?
The bridge is simple, but it's massive. You start with that net loss, which includes the $1.9 billion impairment charge. Analysts just strip that out immediately.
Because it doesn't affect immediate cash flow.
Or the viability of the ongoing core business, right? And then they'll also exclude other items deemed non-recurring, like gains or losses on early extinguishment of debt, which we'll get to, and that non-cash provision release we mentioned.
And once you normalize for all that, what's left is just the operating profit from the 27 active premium rigs.
And that number exceeded expectations.
That contrast perfectly illustrates the investor dilemma here. You have a structurally healthy operational entity trapped inside a historically leveraged, currently impaired balance sheet.
And it forces you to decide which narrative you believe more strongly.
Which naturally transitions us to management strategy. It is crystal clear they are executing a deliberate, focused plan to shed non-core assets.
And to double down purely on premium, high-specification equipment.
Their goal is quality over quantity.
Absolutely. As of September 30th, their working fleet stands at 27 mobile offshore drilling units. That's 20 UDW floaters and 7 HE floaters. But that fleet size is still shrinking strategically.
Right. They announced they intend to dispose of an additional 4 drill ships and 1 HE semi-submersible.
So that brings the total number of rigs being retired, including those already announced and impaired, up to 9. And this whole disposal process is expected to be finalized by mid-2026.
The rationale here seems multi-layered.
It is. First, it strictly aligns the company with customer needs. The oil majors just won't use older, less reliable equipment for these complex, multi-billion-dollar deepwater projects anymore.
And second, and this is crucial, it actively supports a better balanced industry supply-demand dynamic.
Yes. By removing competitive supply, Transocean is effectively strengthening the pricing power of its remaining superior assets.
They also estimate this will save them, what, 10 to 15 million in annual operating expenses?
That's right, by cutting maintenance and stacking costs.
And we can see the immediate effect of this focus in the Q3 operational KPIs, and the numbers are undeniably strong.
They showcase some serious operational execution. Total fleet utilization increased to 76% in Q3 2025. That's a massive jump from 63.9% in Q3 2024.
And the difference between the segments is telling.
Very telling. UDW utilization was 71%, but the highly sought-after EG utilization hit 90.6%.
And management was signaling confidence, saying they believe utilization is currently at the bottom of the trough.
With acceleration expected from here as new contracts kick in. That's their view.
And efficiency was nearly flawless.
Yeah, total fleet revenue efficiency reached 97.5%, a noticeable increase from 94.5% year over year.
Achieving that kind of efficiency means very little unplanned downtime, which is, the holy grail for a drilling contractor.
They even specifically highlighted achieving 100% efficiency across the active fleet in September of 2025 alone.
That's a powerful performance indicator. It demonstrates superior uptime and reliability compared to lower-spec competitors.
And this operational excellence, it supports their average daily revenue growth. The ADR increased 6% to $462,300 across the fleet.
UDW ADR was $462,200 and HE ADR was $467,100.
The fact that both utilization and pricing are moving up at the same time is what confirms that structural recovery narrative in the premium segment.
Beyond just the metrics, we need to focus on the technical capabilities that actually justify those high day rates. Management highlighted a truly impressive technical achievement involving the 8th-generation drill ship, the Deepwater Titan.
Oh yeah, the Deepwater Titan ran the heaviest casing string on record.
The numbers are incredible. We're talking about a hook load of approximately 2.85 million pounds.
To give you some perspective, that's roughly equivalent to hoisting 3 fully loaded Boeing 737 passenger jets.
Wow.
This feat showcases not just the rig's capacity, but Transocean's engineering expertise. And that translates directly into unlocking significant well construction and production efficiencies for their customers.
And this high-spec capability, it creates a competitive moat. When you talk to the majors, BP, Shell, Petrobras, they need this kind of proven technology for their most complex programs.
And it justifies the premium price.
Which leads directly to the strategy around contracts rolling off. High-spec units like the Deepwater Proteus and Deepwater Skyros are coming off their existing contracts soon.
And management has emphasized that they are supremely confident in securing disciplined, strategic contracts for these premier assets.
And this is where that commercial discipline comes in. They stated very clearly that if securing a highly economic contract means accepting short periods of white space
or idle time between projects,
they are willing to take that strategic pause.
And this is a critical philosophical shift from prior downturns.
How so?
Rather than rushing to secure continuity at a reduced day rate just to maintain utilization, they're holding the line on price. They see these high-spec units as having significant leverage in a tightening market, and they aren't willing to compromise that value just to avoid a few weeks of idleness.
So they're optimizing for long-term day rates, not short-term utilization stats.
Exactly.
Okay, let's talk about the balance sheet. It's been Transocean's Achilles heel for a decade, but the actions taken in and around Q3 suggest a really aggressive, transformative focus on deleveraging.
Management views accelerated debt reduction as the absolute key objective to unlocking total shareholder return.
And the commitment they laid out is substantial. They set a highly aggressive target to reduce gross debt by approximately $1.2 billion by the end of 2025.
That target significantly exceeds the scheduled maturities for the year, which were $714 million. So they're accelerating over $500 million in debt retirement.
And the expected payoff from this is clear. An annualized interest expense reduction of about $87 million.
That's a huge operational cost savings that flows directly to the bottom line, which management has said they intend to use for even more opportunistic debt reduction.
But achieving that target required some tough choices, and this is where some of the market skepticism comes in.
It is. They executed 2 major financing transactions to generate the cash. First, in September, they completed a public equity issuance of 143.8 million shares.
And that generated $421 million in net cash proceeds.
It did.
Now, this is the point we really have to interrogate. That equity offering resulted in shareholder dilution of nearly 13%. Is accelerating the retirement of debt that wasn't even due until 2027 worth diluting existing shareholders by that much?
Well, that's the core trade-off.
Huh.
Management would argue, and I think persuasively, that it is absolutely worth it.
Why?
That 2027 maturity wall was a constant credit risk overhang. It was suppressing the stock's valuation regardless of how well they performed operationally.
So, by using the dilution to generate cash and retire $1.2 billion in debt, they dramatically de-risk the near-term capital structure.
They do. They reduce total interest costs, and they secure a much more favorable debt maturity profile right as the industry recovery is expected to hit full steam in 2027.
So it's painful now, but strategically essential to free up the stock price long-term.
That's the argument. The cash from that dilution plus their existing liquidity was then deployed very strategically. First, they did a new debt issuance post-quarter end on October 15th.
Right. They issued $500 million aggregate principal of 7.875% senior guaranteed notes due in 2D032.
And they got $492 million in net cash from that. Crucially, the 7.875% rate they secured was noted by management as favorable compared to the 8% notes they were retiring.
So they're swapping short-term, higher interest debt for longer-term, slightly cheaper debt, improves the maturity profile and the rate?
Exactly. And this cash was then immediately channeled into debt redemptions in October. They used a massive $903 million cash payment to fully redeem $655 million of 8% notes and $248 million of 6.875% notes.
And both of those tranches were originally due in February 2027.
Right. So that action single-handedly took the teeth out of their most immediate major debt cliff.
They also completed some targeted debt tender offers.
They did. They used another $100 million in cash to retire about $89 million of notes due in 2041 and $16 million of notes due in 2028. This resulted in a combined principal reduction of another $105 million.
You know, these maneuvers had a huge side benefit related to collateral flexibility, something that investors just looking at the debt principal might miss.
This is a key technical win for management. By paying down those 2027 notes, they successfully released the Deepwater Poseidon from the collateral pool backing their secured credit facility.
Okay, so why does releasing the Deepwater Poseidon matter?
Because the Poseidon is one of their newest, highest spec UDW floaters. By releasing it, they now have a premium unencumbered asset.
So that can be used as fresh collateral for future financing needs.
Or it just allows them to deploy that rig without the contractual restrictions of being tied to a secured credit facility. It's a crucial move in liability management that increases their strategic flexibility.
So what's the overall picture now? Total debt principal was at $6.297 billion as of September 30th.
Right, already down from $6.944 billion at the end of 2024. And their debt maturity profile at the end of Q3 showed about $1.4 billion due by September 2026, a number that is now much more manageable.
And liquidity.
They ended Q3 with $1.8 billion total liquidity, including $833 million in unrestricted cash. However, after all those debt payments, the CFO clarified that forecasted year-end 2025 liquidity will probably settle just over $1.4 billion.
Still robust, but it shows they're deliberately using liquidity to attack the debt. Okay, let's pivot now from historical performance and balance sheet repair to the forward view, starting with the near-term guidance for Q4 2025.
Right. This gives us insight into how the immediate operational environment is expected to continue.
So for Q4, contract drilling revenue is guided to be between $1.03 billion and $1.05 billion.
Which suggests sustained, strong operational output, maintaining that billion-dollar revenue quarter run rate.
On the cost side, O&M expense is projected a bit higher than Q3, expected between $595 and $615 million.
And that increase is primarily due to two things: the non-recurrence of that $10 million legal provision release they saw in Q3, and some higher out-of-service maintenance activity.
Which is necessary to keep those premium rigs at peak efficiency.
Exactly. Net cash interest expense for Q4 is guided at about $122 million, which reflects that heavy, though improving, debt load.
And capital expenditures remain pretty restrained, projected between $25 and $30 million.
Right. And looking further out, management also provided preliminary full-year 2026 forecasts.
The anticipated contract drilling revenue is projected to be pretty robust, falling between $3.8 billion and $3.95 billion.
And the key statistic there is that 89% of that forecasted 2026 revenue is already associated with firm contracts.
Which gives them excellent visibility and stability.
It does. For 2026, they expect O&M expense to be between $2.275 and $2.4 billion, with G&A stable between $170 and $180 million.
And the forecasted 2026 cash interest expense post-deleveraging is expected to be about $480 million.
Right, reflecting that $87 million in annualized savings we just talked about. And CapEx remains disciplined, projected at $125 to $135 million.
These forward numbers are all underpinned by management's, well, deeply optimistic market outlook.
Extremely optimistic. And it boils down to geopolitical necessity and geological scarcity.
The long-term fundamentals are strong due to instability, supply chain vulnerabilities, and the growing mandate for energy security.
Right. Customers can't just rely on short-cycle shale plays anymore. Crucially, management pointed to the unsustainable decline in the oil majors' reserve-to-production ratios.
Let's unpack that reserve-to-production issue. Why is that forcing their hand now?
Well, for years, the majors practiced capital discipline. They focused on returning cash to shareholders instead of investing in these massive exploration projects.
And that was sustainable for a time.
For a time. But now, their reserves just aren't being replaced fast enough to sustain future production. They're burning through their reserves faster than they are proving up new ones.
So this imbalance creates an absolute necessity to increase deepwater exploration.
It does. Management said they haven't heard this level of urgency over the past decade. Deepwater projects, while expensive, are long-life, reliable sources of large volumes.
So the fundamental need for reserve replacement is finally overwhelming that pressure for immediate capital discipline.
That's it. And it's directly accelerating the contracting pace. Tendering activity is improving sequentially. Q3 awarded 18 rig years, up from 14 in Q2 and 12 in Q1.
And management expects Q4 to be very strong, with momentum carrying deep into 2026.
This sequential acceleration proves that the recovery is robust and it's gaining speed.
The utilization forecasts based on this demand are, well, what we would call tightening rapidly.
They are. Management anticipates UDW fleet utilization will bridge over 90% by the end of 2026 and accelerate into 2027.
And for high-spec HE semi-submersibles, they're projecting close to 100% active utilization in 2027.
And utilization above 90% changes the pricing dynamic completely. On day rates, they noted the resilience of 7th-gen units, holding firm around $400,000 a day.
But once utilization crosses that 90% threshold,
it creates a structural scarcity for the remaining high-spec rigs, which is expected to put massive upward pressure on day rates. We could see 7th and 8th gen rigs push well beyond the $500,000 mark on average.
Let's talk about the specific geographical hotspots driving this. Where are these high-value, multi-year tenders concentrating?
Brazil is central. They anticipate the Petrobras Búzios and Mero tenders, plus Shell's Gato do Mato tender, will all be awarded imminently.
And those 3 projects alone total 23 years of firm work, requiring 6 premium rigs. That's a huge backlog opportunity.
Massive. Then in the U.S. Gulf, we saw concrete evidence of this premium pricing power with BP.
Right. They exercised a 1-year option for the 8th gen Deepwater Atlas at a staggering rate of $635,000 per day.
That contract is the proof point of the scarcity argument. That rate, $635 a day, is a Tier 1 price point. It shows that when a major needs the highest capability, they are willing to pay a premium.
And this extension added $232 million to Transocean's backlog, extending the contract through Q2 of 2030.
Right. They also expect 3 short-term programs with independence to be awarded in Q4 in the Gulf.
Africa is also becoming a growth engine. Total recently lifted force majeure on its $20 billion LNG project in Mozambique,
which is a huge positive sign that major capital projects are reactivating, and we're seeing imminent activity elsewhere. The Ivory Coast has Eni's Baleine Phase 3 tender, expected to start in early 2027.
And Namibia is preparing for a major development program that's expected to be tendered for 2 rigs starting in 2028.
So this all speaks to a strong, multi-year pipeline for deepwater assets in the region.
And we can't forget the North Sea, where the HE floaters live. Norway is still robust.
Very robust. Utilization is expected to be strong through 2027 as they await the imminent award of Equinor's rig tender. This sustained demand is critical for keeping that HE segment at its near 100% utilization forecast.
Okay, We must now bridge the gap between this overwhelmingly positive operational narrative and how the broader market currently views Transocean.
And for that, we'll look to LSEG data for that quantitative perspective as of mid-November 2025.
So, starting with momentum, the stock closed recently at $4.08. Price momentum is very strong, a 9 out of 10.
They've seen a 3-month return of 38.3% and a long-term 5-year return of 246%. Significant, albeit highly volatile, recovery.
The valuation metrics, however, are conflicting, which speaks directly to that tension we started with.
They are. The trailing PE is not applicable because of those massive GAAP losses, but the forward PE sits at 19.9.
And what's interesting about that 19.9 is that it represents a steep 56% discount to their 5-year average forward PE of 45.3.
So that deep discount suggests the market knows the earnings are depressed by non-cash items and debt servicing, but it still finds the stock a bit expensive relative to current profitability.
And the underlying issue is confirmed when you look at peer comparisons. RIG's net margin is reported at negative 75.7%.
The lowest in its entire industry group. And their debt-to-capital ratio is high at 38.4%, reflecting that heavy leverage.
And this high leverage and volatility profoundly impact the risk profile.
It does. RIG has a neutral risk rating, a 5 out of 10, which is significantly below the S&P 500 average of 8.4. And remember, a higher score means lower risk.
So the companies is perceived as fundamentally higher risk than the broader market, and the stock is notoriously volatile.
Extremely. Daily price fluctuations exceeded 97% of S&P 500 firms over the last 90 days.
It also offers low diversification benefits with a high 42% correlation to the S&P 500 over the last 5 years.
Which means it often just moves with the general market, amplifying both gains and losses.
And the analyst consensus reflects this persistent caution. The mean IBES recommendation is a hold from 15 analysts,
with a 12-month mean price target of $3.95.
So analysts believe the operational progress is largely priced in, and they're waiting for more proof of sustained, normalized profitability.
And this brings us to the core conflict defining the whole investor debate. The deep value argument versus the immediate hold sentiment.
Okay, lay out the deep value case for us.
The proponents argue that the market is entirely failing to price in the structural scarcity of these premium offshore assets, which are effectively irreplaceable today.
They see the huge debt load, $6.55 billion, as masking the true operational value and cash flow potential once the industry hits peak utilization.
Exactly. For them, the recent aggressive refinancing is the critical re-rating catalyst that will transition the stock from a financial restructuring story to an earnings growth story, eventually unlocking significant equity value.
And on the other side, the hold camp.
They're focused entirely on the near-term financials and execution risk. They point directly to that recent 13% dilution from the equity raise as an immediate drag on shareholder value.
They also argue that even with high day rates, based on 2026 and 27 profitability estimates, RIG still trades at a high valuation premium compared to many of its peers.
Right. They ask, why invest in RIG when profitability is still several quarters away and the balance sheet is still so burdened compared to competitors with cleaner capital structures?
And finally, we have to note the insider trading score,
which is negative, a 1 out of 10. LSEG data highlighted recent selling activity by CEO Keelan Adamson and other officers in October.
And while those sales may have been part of pre-scheduled plans, the optics of executive selling right after a contentious equity dilution and before this major recovery is fully realized.
It adds a layer of skepticism for the cautious investor.
Okay, let's synthesize all of this. We have Transocean executing a clear, aggressive, and dual-pronged strategy. They are strategically shrinking their fleet by retiring 9 older assets,
taking a massive GAAP hit, but effectively ensuring their position purely as a premium, high-spec player in a supply-constrained market.
And crucially, they're successfully de-risking their near-term balance sheet. They're aggressively accelerating debt retirement, targeting $1.2 billion paid down by year-end.
And this action materially reduces future interest expense and significantly simplifies their capital structure. That key 2027 maturity cliff is now much less terrifying.
Operationally, the picture is excellent. We're seeing sustained high efficiency, strong utilization, and a proven ability to command high day rates.
Underscored by major contract extensions like that BP option at $635,000 a day through 2030. This performance fully supports management's extremely confident outlook for 95% plus utilization by 2027.
The market, however, remains skeptical and cautious, which explains the neutral hold analyst ratings and the high-risk profile.
The market is still heavily focused on rigs' multi-year debt legacy, the negative net margin, and that immediate dilution from the recent capital raise.
But the central long-term question for you as an investor remains this. Management has proven its commercial discipline, refusing to accept lower rates, and its financial agility aggressively tackling debt. Given the structural scarcity of these premium deepwater assets, does that operational strength and pricing power eventually mean that the market will have no choice but to re-rate rig?
Allowing operational value to finally win out over the legacy credit concerns as the industry firmly turns the corner in 2027 and beyond.
That is the pivotal moment.
It is. As oil majors shift massive capital back to exploration to address their reserve replacement crisis, the limited supply of 7th and 8th generation rigs guarantees Transocean ultimate leverage in contract negotiations,
Potentially delivering normalized earnings that finally justify that deep value argument.
That's the thesis.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful markets. Measurable meaning.